Taxes made up more than 42% of the average Canadian's expenses in 2024 and are the single largest expense that Canadians will have over the course of a year. I'm going to walk you through the most commonly used strategies for you to pay less tax right now. For business owners, getting your corporate structure right is crucial. You can sell up to $1.25 million of the share of your business tax-free if the shares qualify as eligible. In order to be eligible, there are certain income and asset tests you need to meet. Failing to do so will cause you to pay an extra $400,000 in taxes. The government absolutely does not care and will happily capitalize on your ignorance. You can also set up a trust to multiply your capital gains exemptions to your family, meaning instead of you claiming the capital gains exemptions only, your kids and spouse can claim it as well, potentially saving you millions of dollars in taxes. This is a complex setup and needs lawyers and accountants to do it properly, but it is absolutely crucial. Also, keeping money inside of your business and investing it there versus paying yourself extra to invest in an RSP will cost you more money in taxes. The corporation gets taxed on its investment income every year. The RSP does not. Both are fully taxable when withdrawn. So you are better off having your dollars compound in an RSP without taxes affecting its growth every year. Now, if you're employed and earn T4 income, max out your TFSAs where you can, but don't use it as a savings account. Many people don't understand that a TFSA is a compounding engine because the growth is completely tax-free. If you use it to shelter money that's invested in a savings account earning 1% interest, that is an absolute waste of allocation. Use it to shelter high growth equity and dividend paying investments. Next is that you should max out your RSPs when you can, but be selective in the years where you claim the deduction. You don't need to claim the deduction in the year you contribute. You can carry forward to a year where you are earning higher income and the deduction will have a more meaningful impact because of our progressive tax rates. But in the meantime, you can get tax deferred investment growth. This is crucial, especially for those who have maxed out their TFSAs. Next is expense allocation. Once you've maxed out your registered investment plans, any other investment you make outside of the registered plans will cause the growth to be taxable. If you're married and your spouse makes significantly less money than you do, for example, you make $250,000 and your spouse makes $60,000, it would be beneficial for your spouse to own the taxable investments because there'd be lower tax on the growth. The problem is you can't just give them the money or else the government will attribute the growth back to you anyways, and it'll be taxed at the highest marginal tax rate. With this strategy, instead, you, the high earner, will pay all the household expenses, the TFSA contributions, your RRSP contribution, and then a spousal RRSP contribution for your spouse. Your spouse then uses 100% of their after-tax income to invest in non-registered accounts. This way, you're not giving them the money, there is no attribution, and the growth will be taxed in their name only. This is a fantastic strategy that just requires you track where your paychecks are deposited to and where your expenses are paid from.